Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing world of business filings to find hidden gems. This quarter, Webster Financial Corporation served up a plate of numbers that are pretty interesting, and we're going to dig into what it all means for their customers and their bank accounts. Webster Financial Corporation, a name you might recognize as a pretty big player in the banking world, has released its latest quarterly report, and let me tell you the numbers for the period ending June 30, 2020, 2020, 2020, 2020, 2020, 2025 paint a picture of a company navigating some interesting currents. They're a pretty substantial company too, with around $82 billion in assets by mid-2005. They operate mainly in the Northeast, but their reach extends further. They've got three main business areas: commercial banking, healthcare, financial services, and consumer banking. Let's jump straight into the money, shall we? For the 3 months ending June 30, 2025, Webster reported a net income of close to $259 million. That's a big jump from the $81 million they made in the same period last year. And for the first 6 months of 2025, their net income was almost $486 million, up from around $398 million in the first half of 2024. This means their earnings per common share also saw a nice boost. Now, take a look at this non-GAAP number. Return on average tangible common stockholders' equity. For the 3 months ending June 30, 2025, it was almost 18%, up from about 14% the previous year. This is a key metric that shows how well they're using their core capital, the money shareholders actually put in to make profits. A jump like this, and it means they're getting more bang for their shareholder buck. Interestingly, non-interest income as a percentage of their total revenue increased significantly. That means more of their earnings are coming from things other than just the difference between what they pay for deposits and what they make on loans. This is generally a good sign, showing they're diversifying their income streams. Their net interest margin, which is basically the difference between the interest they earn and the interest they pay out, held pretty steady. For the 3 months ending June 30, 2025, it was 3.44%, a small increase from 3.39% in the same period last year. This also held steady for the 6-month period. It's good to see this core banking profitability remaining stable, especially with those big jumps in asset size. The provision for credit losses, which is money set aside for potential loan defaults, saw a mixed picture. For the 3 months ending June 30, 2025, it decreased compared to the previous year, which is usually a good sign, suggesting they expect fewer borrowers to default. However, for the first 6 months of the year, it actually increased. The company mentioned this was due to higher net charge-offs and uncertainty in the economy, but also improvements in risk ratings, which is a bit of a mixed bag of signals. Let's look at non-interest income categories. Deposit service fees remained pretty flat, which is normal, but loan and lease related fees went down a bit. Wealth and investment services also saw a slight decrease. On the flip side, the cash surrender value of life insurance policies went up quite a bit, and other income also increased. However, the biggest driver for the jump in non-interest income was the change in gain-loss on sale of investment securities net. In the 3 months ending June 30, 2024, they had a pretty significant loss on these sales. But in the same period of 2025, there were no sales. This is a big swing that definitely boosted their overall non-interest income. The same pattern held for the 6-month period as well. With a significant loss in 2024, there were no sales. This is a big swing that definitely boosted their overall non-interest income. The same pattern held for the 6-month period as well, with a significant loss in 2024 and a slight gain in 2025. There were no sales. This is a big swing that definitely boosted their overall non-interest income. The same pattern held for the 6-month period as well, with a significant loss in 2024 and a slight gain in 2025. Now, expenses. Total non-interest expense actually went up by about 6% for the quarter, mostly driven by higher compensation and benefits. The company pointed to investments in human capital and risk management. Occupancy costs also jumped, but that was partly due to a one-time lease termination benefit in the prior year, making the current year look worse by comparison. Professional and outside services also increased, mainly due to higher technology consulting fees. Diving into their individual business segments, commercial banking saw its pre-tax, pre-provision net revenue, or PPNR, decrease by about 10% for the quarter. This was mainly due to lower net interest income and non-interest income, along with higher expenses. They mentioned lower spreads on loans and leases and increased investments in technology. Looking at the commercial banking balance sheet, their loans and leases grew slightly, mainly from commercial non-mortgage loans, but overall originations were up compared to last year. Their deposits, however, stayed pretty much the same, with some seasonal outflows in public sector deposits offsetting growth elsewhere. Moving to healthcare financial services, which includes their HSA Bank and a mattress business, PPNR for this segment increased by about 4.4% for the quarter. They saw higher deposit balances and increases in interchange and medical fees. Expenses also rose, driven by compensation and benefits. Deposits in this segment increased by about 2.2%, mostly due to more HSA Bank and Amatress account holders. Assets under administration also grew significantly by over 8%, reflecting more account holders and a bump from market volatility. Lastly, consumer banking. PPNR increased by about 2.7% for the quarter. This was thanks to higher net interest income from increased loan and deposit balances, and a better interest rate spread on loans, though deposit spreads were lower. Non-interest income was up slightly, but expenses also grew, driven by technology investments and employee costs. Consumer banking saw loans grow by a healthy 4.9%, with residential mortgages and other consumer loans driving this. Deposits also increased, especially in online savings accounts. Assets under administration decreased, though, mainly due to the sale of 2 investment portfolios and market volatility affecting account balances. Overall, Webster Financial Corporation's total assets grew by about 3.7% from the end of 2024 to mid-24 to mid-24. This growth was spread across several areas, including cash and cash equivalents, a rise in investment securities, and a significant increase in loans and leases. On the liability side, total deposits went up by about $1.5 billion, largely due to increases in money market accounts, especially from their interstances service. FHLB advances also increased significantly, reflecting a shift in their short-term funding mix. Now let's talk about their investment securities. Their available for sale securities portfolio grew by about 6.8%, while they have some unrealized losses on these totaling over $610 million at June 30. The company believes these are not credit related and expects them to recover. Their held to maturity securities portfolio, however, decreased slightly. They also have substantial unrealized losses here, around $91 million, again mostly attributed to lower market interest rates. Looking at asset quality, non-performing loans and leases as a percentage of total loans and leases increased to 1.0%, up from 0.0, a key indicator of loan quality, and that increase warrants attention. However, their allowance for credit losses, which is the money set aside for bad loans, also increased, and it remains quite high relative to non-performing loans, which is a positive sign. The total allowance for credit losses went up by about 4.7%, partly due to economic uncertainty, but also due to loan growth. The company mentioned a new qualitative factor added to their models to account for economic uncertainty, like proposed tariffs and recession risks, which added about $17 million to their reserves. When we look at the credit quality of their commercial loans, about $1.4 billion originated in 2025 are currently rated as pass. This means they're considered good loans. However, looking at the breakdown, almost $81 million of commercial non-mortgage loans from or before 2022 are rated substandard, and about $44 million of those as of June 30, 2020 are rated substandard, and about $44 million of those as of June 30, 2020 are from 2025 itself. That's a bit of a red flag. In their consumer portfolio, specifically for residential loans, they have 0 loans in the 579 and below FICO score category as of June 30, 2024, when they had over $900,000 in that category. And it suggests they're managing their risk well in that area. The Amatress acquisition completed in January 2024 definitely had a big impact, particularly on their goodwill. The company recorded about $228 million in goodwill from this deal, which essentially represents the future economic benefits expected from that acquisition. It's all allocated to their healthcare financial services segment, showing management's strategy with that deal. Webster seems to be committed to returning value to shareholders. They repurchased over 5 million shares through buybacks in the first half of the year, totaling about $260 million. Plus, their board increased their share repurchase authority by another $700 million. This shows confidence from the company in its own stock. And speaking of leadership, John Triller, their chairman and CEO, entered into a trading plan in April 2025, which will see about 32,000 shares of common stock sold over the next year or so. This is common practice for executives to diversify their holdings, and it seems to be done through a pre-arranged plan. Now let's talk about my take on Webster Financial Corporation. They're definitely showing growth, especially in earnings and key performance indicators like return on tangible common equity. The diversification of income sources is also a positive sign. However, there are a few headwinds. The increase in non-performing assets, particularly in their commercial real estate and asset-based loan portfolios, warrants close monitoring. While their allowance for credit losses is robust, any significant deterioration in these areas could pressure their earnings. The rise in compensation and technology expenses also indicates ongoing investment, which is necessary for growth, but it does eat into short-term profitability. The strategy of holding higher levels of on-balance sheet liquidity, particularly in FRB deposits, seems to be a prudent move in uncertain economic times, though it can slightly depress short-term yields. Their investment in HSA Bank and Ametros via the healthcare financial services segment is clearly a growth engine, with increasing deposits and assets under administration. Overall, Webster Financial Corporation appears to be a solid, growing bank. They're strategically investing in their future and showing improved profitability. However, like all financial institutions, they are sensitive to economic shifts, and keeping a close eye on their loan quality, especially in commercial segments, will be crucial for continued success. Alright, that's our breakdown of Webster Financial's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.